Okay, cool. Let's get into some macro charts that I saw last night that I thought were actually very interesting and will fill everyone with a ton of hopium, hopefully. So first of all, this was the chart of the week by Fundstrat. I thought this was a very, very interesting chart because, well, it says we're going to go up 20%. So that's why I thought it was interesting. I was like, oh, wow. A chart that says we're gonna moon. That makes me happy. So this is the point of the chart. Every time we've had a 10% correction, which was very fast. What do I define as fast, or what does Fundstrat, Tom Lee, define as fast? He defines 20 days or less. 20 days or less when we've had a 10% correction from peak to trough. 6 out of 6 times, the S&P 500 12 months later was up 21%, 20.8%. 1 month later, it was up on average 2.9%, 3 months, 8.2%, 6 months, 15%, 12 months, 20.8%. So in the previous 6 times, we had a 10% correction within 20 days. It was COVID. It was the trade war in 2018. It was Eisenhower had a heart attack in 1955. It was the Korean War in 1950. It was the Volcker shock in 1979. And it was the Asian financial crisis in 1997. And this time it was, I guess you can chalk it up to Trump tariff tweeting for that really is how you would define it, right? Like you look at COVID, the trade war, Korean War, and then Trump tariff tweeting. That would be the way we define 219 to 311 of 2025 as the 7th 10% decline in the fastest period ever, which would be 20 days. A year later, we're up 21%. So if historically we continue to go down that route, then maybe, just maybe, there is a shot that this correction is done with. And because this correction theoretically could be done with, that means we have room to go higher. Now, here is some counter data to manage some of the bullishness with some bearishness as well, which is the NASDAQ completed a rare 4-week losing streak, dropping 2% each week. This has only happened 7 times since 1970. Historically, data shows that this pattern typically leads to continued weakness over the next 2 to 3 months, meaning that the next 2 to 3 months could be choppy. Now, granted, it's not necessarily conflicting with the other piece of data because the other piece of data says, hey, in the next 12 months, we're still going to be up. Even on this chart with the NASDAQ going down 4 weeks in a row, the 12-month return on the NASDAQ is 8%. So I know maybe we don't get 21% like on that S&P 500 chart. Maybe we only get 8%, but that's still, relatively higher from where we are right now. All the signs are pointing to choppiness in the short term with the type of velocity of speed that we had going down, whether it was on the NASDAQ or the S&P 500. But it also does show that the recovery a year later, based on how fast that decline is, tends to be up because most people just buy that dip, and that dip gets to the point where valuations like NVIDIA gets to 104, which it becomes egregiously attractive, and money steps in. Money market funds last week actually lost $1 billion. I was surprised by that. Money market funds, I know $1 billion isn't a lot of money, but the fact that they decreased by $1 billion and they didn't add to the money market funds, meaning cash didn't leave markets and go to the sidelines because of how scared they were, it kind of shows a little bit of peak fear. And even money from money market funds was like, all right, this is stupid. We're at least going to, nibble in on this dip. And maybe that's some of the momentum we saw last week as well, at least on Thursday and Friday, to get some of that momentum. So does that mean buy the dip? I don't know if that means buy the dip. I do think that means nibble at the dip. If you have 20 grand to buy the dip, maybe you spend 2 grand out of it, right? 10%, and just start to slowly nibble in. I think a couple of years from now, this dip isn't seen like anything too crazy, but a couple months from now, it could be worse. And that's something that I don't think we can be excited enough to say we've called the bottom, just given you don't know what Trump's going to tweet tomorrow, dude. And I just feel like until the markets are completely desensitized to it, one of the reasons Friday was green is because Trump didn't say anything about tariffs. And so markets didn't have anything to react to. Today, you just don't know. April 2nd, by the way, is going to be a very important day. That's when the tariffs go into effect on Canada and Mexico. And maybe the markets are just assuming that that's going to be delayed again, and hopefully it is. But I don't think that's something we can necessarily ignore going into the next coming weeks. Now, Mike Wilson, who historically has been rather bearish, he published a piece from Morgan Stanley saying the correction might be over. He said, in short, we stand by our view that 5,500 on the S&P 500 should provide support for a tradable rally led by the lower quality, higher beta stocks that have sold off the most, as it looks and may have started on Friday after the S&P 500 traded at 55.05 on Thursday. The important question is whether such a rally is likely to extend into something more durable and mark the end of the volatility we've seen year to date. The short answer is probably not. First, from a technical standpoint, the major indices have suffered significant damage, more than we witnessed in the recent 10% corrections like last summer's. More specifically, the S&P 500, NASDAQ, and Russell growth and value indices have all traded straight through their respective 200-day moving averages, now making these levels resistance rather than support. Meanwhile, many stocks are closer to a 20% correction, some stocks really 30 to 40%, with the lower quality Russell 2000 falling below its 200-week moving average for the first time since the 2022-2023 bear market. At a minimum, this kind of technical damage will take time to repair if it doesn't lead to more price degradation at the index level, basically saying, hey, we could see a rebound to the 200-day moving average on the S&P from 5,500 to 5,700, but that does not mean we are out of the blue. Right? That does not mean that we are going to be able to meaningfully get out of the issues that we're having in the context of the downside momentum that, Mike Wilson has a fair point. It's like, you're not just going to repair the 10% down based on like this August 5th type of recovery. Now, if that does happen, the question is, what has the market found out that is easy enough for them to overlook, right? Because on August 5th, it was Japanese yen carry trade was stupid. Like, it was a thing and then it wasn't a thing. So the markets were able to overlook it. This tariff stuff isn't necessarily stupid, even though it feels stupid. It's not fully recovered yet. And if it's not fully recovered yet, then I think there's still going to be some issues in regards to how we navigate the tradableness of this rally. But it is tradable. It could actually be tradable, which is what we're seeing right now, right? I mean, like, we're seeing a nice little green pre-market. I think there's going to be a lot of traders that step in. Tesla's down, though. Why is Tesla down? You would think Tesla would move with all these growth stocks. It's down 1.25%. It was up 4% on Friday. Maybe there's a headline on Tesla. But outside of that, everything else is relatively green on this pre-market. Okay, Ed Yardeni. He is one of the biggest bulls on Wall Street. He had a $7,000 price target. He has reduced that $7,000 to $6,400. This is another sign of either a bottom because you got bulls capitulating, or it's a sign of like things are getting aggressively worse because you got bulls saying, hey, our targets were way too aggressive. Here's what he has to say on the current state of his target.
Because of what is happening with tariffs right now?
Absolutely. And that obviously relates to valuation. Valuation has been stretched. Everybody knows that. But the outlook for the economy was pretty good until we got hit by this tariff issue. And it looks like it's not going to go away anytime soon. So surely valuations aren't going to stay as high. And they have, in fact, come down. For the Magnificent Seven, they're down from 30 to 25. For the S&P 500, they're down from 22 to 20. So I've adjusted for valuation. I still think the economy is going to prove to be resilient as it has been for the past 3 years. And if that's the case, then the earnings story should hold up. But the valuation story is not as strong.
Directly because of additional prices that might work their way into erode manufacturers' margins?
Well,
or because of an economic slowdown?
Yeah, good point, Becky. I mean, 2 weeks ago, we raised the subjective odds of a recession from 20% to 35%. So, I'm realistic. I look at the data. We are saying that the tariff issue is unnerving consumers. And they are concerned that the price outlook isn't for them to come down. I think the president has scored some good points here in terms of seeing energy prices coming down somewhat. Mm-hmm. Clearly, the tariffs have worked with regards to pressuring Mexico to deal with the southern border. And another important development here is that with all the turmoil on tariffs, there has been some really good consequences for the rest of the world. China is actually stimulating the consumers, which is what American policymakers have been trying to get the Chinese to do for a long time. And the same thing with regards to Europeans.
Spending more money.
So, yeah. Which then gets into explaining why the bond yield is so sticky here at 4.3%, because bond yields are going up around the world. So, I think America is exceptional in many ways. One of the ways is we have a lot of debt, we have big deficits, and now the rest of the world is joining us in that regard. So they're going to have some exceptional deficits and debt, and that's that's actually a positive, at least in the short term, for global economic growth.
And I should point out that 6,400 for the S&P 500 is still a long way from where it is today at 5,600. So you're still looking for gains at the year. When do those gains start to pick up? You think we've hit the market bottom yet?
Well, I thought late last year, early this year, that the market would be choppy in the first half of the year. It's chopped us up pretty good. But I think by the second half of the year, a lot of the uncertainties about tariffs, I think there'll be negotiations going on. Some of them will lead to lower tariffs instead of higher tariffs. And I think by the second half of the year, we'll see the economy continue to prove its resilience, earnings hanging in there pretty well. And so I think that the second half is when the market moves ahead to new record highs.
I mean, theoretically, most countries that still have large tariffs against us or levied on us are not in a position to pick a fight
Exactly.
with us. And the reciprocal deal, the end result could be some of those tariffs are either cut or taken off completely.
Exactly. And I think that's, I mean, it's conceivable that the market is bottoming now, anticipating all that, because everybody knows that you don't want to go long the market, or you don't want to be buying when April 2nd, we're going to have a slew of reciprocal tariffs, and the president will be talking about them. I've observed of late that any day where the president doesn't talk about tariffs is a good day for the market. And that's why Friday was up, because he wasn't talking about it. But I'm also saying that despite the fact that he's continuing to hammer home the tariff issue, the market is down some today, but so far it doesn't look like it's going to be a terrible day.
So again, this kind of argument by Yardeni around this idea around tariffs, right? Like Friday was a good day because we didn't have any volatility when it came to Trump talking about tariffs. But now, you don't know. April 2nd, there's going to be reciprocal tariffs if Trump allows the current tariffs on Mexico and Canada to go through. And again, they were delayed for a reason. A lot of the car companies called him up and said, hey, bro, like we need some more time. And so do they call him up again on April 2nd and say, we really can't afford to have these tariffs? And if it gets delayed, I think that's a good thing. If it doesn't get delayed, then there's going to be reciprocal tariffs by Canada and Mexico. And so I think we're going to have to see how that plays out on April 2nd, which is basically in 2 weeks. So I don't know. I mean, like buying the dip right here might feel fun because you're like, all right, we're finally back in an uptrend. And it makes sense, especially when you look at some of these valuations. But we've seen valuations get pretty aggressively destroyed to the downside, even if it was irrational, but it was based on the short-term momentum of the market just feeling afraid of what would happen when it comes to tariffs. Like, I don't think SoFi should be at $12. So if I got to $10.80 at one point last week, like I just think that's a little dumb for SoFi. It's up right now, but it could get to those irrational levels again. 1065 is where it got to if this tariff volatility continues to be what it is.